So earlier today, I uploaded a video where I started with ratios and I explained why it is important that we have ratios, that we calculate them, that we analyze them. And it was all about the fact that ratios help us to understand our financial statements better. It also helps us to understand the performance of a company for a specific financial year compared to either the prior financial year or then other companies that operate in the same industry. We then looked at return on shareholders' equity, where we said that this is where we are going to look at the profits that we earn on our investment from the shareholders' perspective. We also said that we want this ratio to be higher than the interest rates offered by banks, because otherwise the shareholders might as well just have their money in a fixed deposit. So we definitely want to earn good returns, and we are going to calculate return on shareholders' equity by looking at our net profit after tax divided by our average shareholders' equity. Average shareholders' equity, meaning that we are going to look at the prior financial year and the current financial year's ordinary share capital and the retained income, and we are going to calculate the average thereof. Then we also looked at NAV, the value of the shares in our financial statements. So what is the value according to our books versus the value that the market links to this asset? In other words, how much are the potential shareholders willing to pay in order to buy shares within my company? And we then said that this must be multiplied by 100 to be shown in shares. If not, you will not get your marks. So compared to the market price. Remember, I also said that if you don't have the market price, then go to the last issued price, because that is what the shareholders were willing to pay in order to obtain those shares within your company. Then we also looked at return on total capital employed, where we wanted to know how much profit are we generating using our total capital. And we said that total capital is your shareholders' equity plus your non-current liabilities. So it consists of your own capital as well as your borrowed capital. Once again, multiplied by 100. And this time, we're not showing it in cents, but we are showing it as a percentage. And we want this percentage to also be higher than the interest rates. And the reason here is because you are borrowing money, and you don't want to borrow money at an interest rate that is higher than the return that you are making on that capital, or then the return that you are making by using the capital to then generate profits. Then we also looked at gearing when specifically with your ROTCE. So when we're looking at ROTCE, we're looking at positive or negative gearing. We are going to say that the company is positively geared if their return on total capital employed is more than the interest. In other words, I'm positively using my capital to generate profits. If your ROTCE is lower than the interest rate, then we are going to say that you haven't been able to generate good profits using your capital, therefore you are negatively geared. Next up, we had creditworthiness. How likely is the business to be able to repay loans? And we are going to look at both ROTCE and debt equity ratio for this specific comment, because remember that your ROTCE is how much profit am I making. So if I can just go back to that one here. There we go. How much profit am I making before looking at the interest that I have to pay on the loan? In other words, do I have enough profits to cover my interest, first of all, and then will I be able to make my repayments on the loan, so my capital portion of the loan? And together with that, they're also going to look at your debt equity ratio. In other words, are you already relying too heavily on third-party loans, or are you making good use of your own capital? In other words, the capital from your shareholders. So debt equity ratio, are we relying too heavily on third-party loans, which means that we are going to literally what the ratio says, we're going to take our debt, our long-term debt, and compare that to our equity. So non-current liabilities to shareholders' equity. Now, when we're looking at this, it's easy to say that if I have R1 equity for every R1 in long-term debts, I should be fine. However, we are going to say that if it is between 0.5 to 1 and 1 to 1, we are going to say that this is a moderate risk. It's moving toward a high risk. But if it is below 0.5 to 1, we are going to say that we are low risk. We are not heavily reliant on third-party loans, because for every R1 in share capital or then equity, we have only 50 cents in loans. So we are relying a bit more on our equity to fund our operations. So for instance, a company with a debt equity ratio of 0.3 to 1 is then, this is good. You are managing your loans effectively. You shouldn't be concerned about this. You are a low risk, you are credit worthy. We're also going to say, together with that, you'll see in a few slides that we'll get there, you will see that we're also going to say that because it is a low reliance on debt, we are lowly geared. But as soon as we move from a ratio of 1 to 1 and upward, we are going to say that clearly we are relying a lot on third-party debts to fund our business, and therefore we are highly geared, and we will most probably not be able to make repayments of loans, not even to now think about the interest that we still have to pay. So we are most probably not credit worthy. And then that's just looking at the increase from the 1 year to the next, shows that. So if we do ask you, compared to last year, do you think this company is now relying more on third-party loans or on capital? Then you are going to compare last year's debt to equity ratio to this year's debt to equity ratio. If it increased, then yes, you did rely more on your third-party loans. So this is also a question we can include in the cash flow statement. So if I give you a cash flow statement where you had an increase in loans, I can ask you, how did this affect your debt equity? Or I can ask you, how did this affect your credit worthiness? So please just look out for the ratios in your cash flow statement as well. Okay, so like I said, we're also going to look at the gearing. So the how much am I relying on these loans versus how much am I relying on my own funds? And if it is below 0.5 to 1, we are going to say that we are lowly geared. So lowly geared, we are safe. We should be able to pay off our loans. We are not heavily reliant on third-party debt. And then the moderate gearing is when it goes from 0.5 up until 1, where there's like more or less a mix of what I'm using. And then anything above 1 is a risk. You are high risk, you are highly geared. So that is your gearing with regards to your debt equity. Then just again with the lower debt equity, so I just included a few examples of ratios that we can give you and then how to comment on those. So if you have a debt equity of 0.4 to 1, then it means that you are mostly using your shareholders' funds to now fund your operations, and you are not heavily reliant on third-party debt. You are credit worthy, you are a low risk. But at this point, you should also just look out for future possible loans. So we can give you a debt equity of 0.4 to 1, and then we ask you, should they obtain a new loan? Then you have to see, if I now obtain this new loan, will I still be lowly geared, or at least moderately geared? Or will this now push me towards I'm highly geared and I'm now becoming a financial risk? So with the 1.8 to 1, that is extremely high. It means that for every 1 rand in shareholders' equity, you have 1 rand 80 cents in loans that you are relying on. So therefore, you are definitely a financial risk. And if you now try to get a new loan from a bank, you are most probably not going to be successful in doing so because you already have too much debt. So I will still make videos on the actual commentary and how to analyze it, but it's always important to first of all understand what all of these ratios are, where do we use them, why do we look at them, and what the industry norm is for each one of them.